Welcome back to the Longacres Finance channel. 2022 has started off with heavy volatility in the market, which can both be a good and bad thing. If you're a long-term investor, volatility may be an opportunity to invest capital at better than average prices. But on the other hand, watching your portfolio value decline is not a pleasant sight for anyone. For me, the heavy price declines in January were a pleasant sight. As a long-term investor, my focus is always 10 or 20 years down the road. If I like the stock at a given price, and now that same security trades for a lower price, I get excited, because I am able to buy more shares for the same amount of money. Long-term investing is really the most ideal approach for the average investor, and it is the best approach to adopt for dividend investing in my opinion. Today I want to take a look at the top 15 high-growth dividend stocks that my screener presents for the month of February. My patrons have already seen the list, as I always release this watch list on the last day of the prior month on my Patreon page. My patrons also get early access to most of the YouTube videos I make, as well as a few other perks. If that sounds like something you may be interested in, you can check out my Patreon page using the link in the description below. Patreon always charges on the first of the month, so if you join now you can check out the benefits risk-free until March 1st. The top 15 high-growth dividend stocks from January lost a collective 4.01% last month, so the watchlist started out the year on a sour note. However, it did generate 1.29% of alpha over VIG and 1.26% of alpha over SPY. The main objective of this watchlist isn't really to beat VIG or SPY, but to build a portfolio of quality dividend-paying companies, and to generate a dividend stream that will grow at a fast rate well into the future. The combination of this watchlist and the high-yield watchlist should result in a portfolio with a decent starting dividend yield, and better than average dividend growth in the future. Let's take a look at the top 15 high-growth dividend stocks I will be considering in February first, and then I'll talk more about past results. The top 15 stocks for February in order of rank are Lam Research, MSCI, Texas Instruments, Cintas, BlackRock, Home Depot, Charles Schwab, Tractor Supply, Northern Trust, Starbucks, Lowe's, CDW, Goldman Sachs, Amphenol, and Rollins. So we have a few of the usual companies that normally appear on this watch list, but also a few new names, and a couple stocks that have appeared on the watch list in the past and return once again in February. The average dividend yield for all 15 stocks is 1.59%. And I know that may seem pretty small, but it's actually one of the best dividend yields this watchlist has produced in the recent past. Based on dividend yield theory, 9 of these companies appear to be potentially undervalued right now, with one more in the fair value zone. Also, 5 companies offer a dividend yield above 2%, which is pretty good for a fast dividend grower. I am forecasting at least 12% long-term annualized returns for all 15 stocks. Whether they all hit or exceed this target, we won't know until years down the road, but I think these 15 companies have the potential to be winners in the long run. Let's go down the list and I can give you a bit more detail about each company. Lam Research lost about 18% in January and presents a much better entry point today than last month. Dividend yield theory still suggests the current share price is about 25% overvalued, but the forecasted rate of return at the current price is above 12%, and that is sufficient enough for me to consider adding more capital to this position. MSCI lost 12.5% last month, but shares still look about 11% overvalued. The low sub 1% dividend yield is not appealing, but MSCI has been growing its dividend rather quickly in the past. The company ranks very well in my quality metrics and has a forecasted rate of return above 12%, suggesting that adding capital at this point makes sense to me. Texas Instruments lost a little more than 4% in January and now offers a more attractive dividend yield of 2.59%. Based on dividend yield theory, the stock appears to be about 9% undervalued, with a forecasted rate of return above 14%. Cintas shed a little more than 11% last month, but still offers a sub 1% dividend yield. The stock appears to be in the fair value zone based on dividend yield theory, and the long-term return forecast is slightly above 12%. This is an excellent boring business with a long history of strong returns. I will be adding capital to Cintas this month. BlackRock lost about 10% in January and returns to this watchlist after an 8-month break. The stock offers an attractive 2.42% dividend yield and also appears to be about 5% undervalued. I am forecasting a 16% long-term rate of return for the stock. Home Depot lost about 11.5% in January and returns to the watchlist after a 3-month gap. The sub 2% dividend yield and about 17% overvaluation are not ideal, but my return forecast is projecting an almost 13% long-term rate of return. I will most likely be adding to my position in February, as Home Depot is one of my favorite long-term holdings. Charles Schwab finished January up 4.28% and is one of the best long-term watchlist stocks. They have appeared on the watchlist for the last 12 consecutive months, returning almost 72% over this period of time. The current dividend yield of 0.9% and the potential 20% overvaluation are not ideal, but I am forecasting continued strong returns above 20% for the stock. Tractor Supply lost 8.5% in January, but also recently announced a monster 77% dividend increase. This shot the dividend yield up to about 1.7% at month-end January, which is well above the trailing 5-year dividend yield. Should the yield revert back to the trailing average, we could see a 27% return on the share price. I am actually forecasting about a 22% long-term rate of return for the stock. I have already added to my position following the recent dividend increase, and I will likely add more throughout the month. Northern Trust pops back onto the watchlist after a 5-month break. The stock lost 2.48% in January and presents us with a slightly better entry point today than a month ago. The current dividend yield of 2.42% looks pretty nice, and the share price is about 6% undervalued right now. I am forecasting a 16 to 17% long-term rate of return for the stock. Starbucks was a new stock to the watchlist last month, and it is here once again in February. The stock lost almost 16% in January, so it's not off to the best start, but the fundamentals still make sense to me. The dividend yield of 2.02% looks pretty good compared to the trailing dividend yield of 1.85%. This also points to about an 8% undervaluation. I am forecasting a 14% long-term rate of return for this coffee giant. Lowe's is one of the long-term watchlist stocks that has been here since the beginning. The stock shed almost 8% last month, but still looks about 20% overvalued. The 1.39% dividend yield is below the watchlist average, but even with the potential overvaluation, I am forecasting a 14% long-term rate of return. CDW returns to the watchlist after making a few appearances in early 2021. The stock shed about 7.5% in January, and sees its dividend yield climb above 1%. Shares look to be about 6% undervalued, with a long-term return forecast of about 15%. Goldman Sachs appeared on this watchlist only once in the past. It was actually the August 2021 watchlist. The stock lost 7.29% in January, and now appears to be about 27% undervalued. It also sports a good 2.31% dividend yield, well above the watchlist average. I am forecasting a strong 20% long-term rate of return for this stock. Amphenol has been a frequent watchlist stock over the past year. The stock lost 9% in January and looks to be about 17% undervalued right now. I am forecasting a 15% long-term rate of return for this tech company. And finally, we have Rollins, a new addition to the watchlist this month. The stock offers a decent dividend yield of 1.34% and looks to be about 27% undervalued. I am forecasting a 15% long-term rate of return for this industrial. There they are, the top 15 high-growth dividend stocks to consider for February. Keep in mind that the valuation and the future return are just assumptions, and you should not base your investing decisions solely on these measures. Also, this watchlist is based on quantitative data and doesn't factor in any recent developments or news about these companies. I encourage all of you to go out there and do your due diligence before initiating any investment decision. Okay, let's talk about past watchlist performance. January was the 17th month that I have been tracking this watchlist, and the long-term annualized rate of return over this period of time is 24.38%, which is still well above my target 12% annual return. Since inception, the watchlist is beating VIG by 8.37% and SPY by 4.56%. January added to these cushions as the watchlist beat both funds by a little bit more than 1%. The best return in January came from Activision Blizzard, thanks to the news that Microsoft will acquire Activision through a full cash deal. Activision finished January up 18.76%. The stock is still down about 13% since it first appeared on the watchlist. But the good news is that the current share price is still below the $95 per share offer presented by Microsoft. So if the deal goes through at some point in probably 2023, investors can still stand to benefit from today's price of about $79. I have been dollar cost averaging into this stock since about May of 2021, while the share price continued to decline based on the news surrounding the company. I will likely hold my position until the acquisition takes place. The second best return in January came from MasterCard, that added 7.67%. Visa also posted a nice gain of 4.37%. Both credit card companies had a rough 2021, so it's nice to see them posting nice results early on in 2022. Two more January watchlist stocks posted positive returns in January. They were Charles Schwab with a 4.28% gain, and Ball Corporation with a 0.86% gain. The remaining 10 selections all finished the month in the red. Here they are in descending order. SS&C Technologies lost 2.57%. Texas Instruments lost 4.15%. Skyworks Solutions lost 5.56%. JP Morgan lost 5.58%. Lowe's lost 7.87%. Amphenol lost 9%. MSCI lost 12.5%. Starbucks lost 15.94%. West Pharma lost 16.12%. And Nvidia lost 16.75%. Certainly not a pretty month for the watchlist, but in the stock market you have to roll with the punches and keep a long-term outlook. My long-term target rate of return is 12%. I'd like to earn at least 12% per year from my portfolio over a long period of time. I know that this is definitely an achievable goal to have, but one that may not pan out in the short term. I have started tracking how well each individual watchlist is performing in the long run. This assumes that you invest equally into the stocks from the watchlist, never add or remove any capital, and reinvest all dividends. The first watchlist from September of 2020 has 17 months on the books now, and it has a 20.11% annualized rate of return. In fact, all watchlists with at least 12 months of history have annualized returns above 20%. The more recent watchlist returns don't look so pretty, following all the recent volatility in the market, but I don't want to judge them on short-term results. I would like to see all individual watchlists to have an annualized rate of return above 12% after a 5 or 10 year period. I realize this may be a long period of time to some investors, but no matter how old you are or how long you have left till retirement, I think everyone should have a long-term outlook on their portfolio. With that, I'll wrap it up for today. Thank you for watching, don't forget to like and subscribe, and see you next time.